Good morning, ladies and gentlemen. I hope you are all doing well. Thank you for joining me today. We are from Team Debit Credit. Next. I am VISHNU and APPLANAIDU together with my team members Muhammad Nur MUHAIMIN bin ZAINI and TAYALAN ETHAYA KUMAR. We are delighted to be here to share our topic with you today. We will delve into and explore the key aspects of deferred revenue and deferred expense. Without further ado, let's go. So, what is deferred revenue? Deferred revenue, also known as unearned revenue or deferred income, is a liability on a company's balance sheet. It arises when a company receives payment from a customer for goods or services that have not yet been delivered or earned. Instead of recognizing the payment as a revenue immediately, the company usually records it as a liability. As the company fulfills its obligation by delivering the products or services over time, it gradually recognizes the deferred revenue as an earned revenue on its income statement. This process is often associated with subscription based services, advance payment for goods, or long term service contracts. In summary, a deferred revenue represents money received in advance, which of the company still needs to provide goods or services, and it reflects on the company's obligation to fulfill these commitments over time. Next page. Next page. The MFRS code related to this topic is MFRS 15, which is revenue from contract with the customer. And the main principle of MFRS 15 is that revenue is recognized when the goods or services are transferred to the customer. Based on MFRS 15, these are the five steps followed by the firms to recognize revenue, which is identifying the contract, then secondly, identifying the performance obligation in the contract, determining the transaction price, allocating the transaction price to the performance obligation in the contract, and recognizing revenue when the entity satisfied a performance obligation.
Assalamualaikum and good afternoon. Okay, for uh for deferred expense is a cost that has been incurred but has not been consumed yet. Uh, for example, I have paid 1,200 ringgit for insurance from January to December, but my financial report ended in June. So the first 600 ringgit from January to June is my insurance expense, while another 600 ringgit from July to December will be my prepaid insurance. In other name, for deferred expense is prepaid prepaid expenses. Okay, we will go to the first question. Okay, the first question. Perniagaan seiring sejalan is a business selling clothes. Below is the trial balance from 13 June 2020. Our first step is we need to identify the contract. So based on the question, we all know that additional information has tell that rental income service of 400 ringgit has not been complete. So after we identify the contract, we recognize that rental income is 1,200 ringgit and it has not been complete 400 ringgit. For second step, we need to separate performance obligation. So we will be using journal to separate those obligation and it will become two new two new we will become a two new account. Okay, the first one, rental income 400 ringgit is in debit side. Why? Another one is unearned rental income in credit side RM400. For the third step and the fourth step, the third step we will determine transaction price, and the fourth step we will allocate transaction price. We will use ledger. So basically there will be two ledger, and the first one is rental income. In rental income ledger, we can see 2020 13 June it will become unearned rental income RM400 and profit or loss RM800. And on the credit side, 2020 June 13 balance BD will be RM1,200. The balancing figure is RM1,200. And for another ledger, it is unearned rental income. In the credit side, 13 June, we will have rental income RM400. And on the debit side, we will have balance CD RM400. And their balancing figure is RM400. We will use ledger to determine the amount that should only be in the current financial year. Okay. This is the new adjusted trial balance. So inside this trial balance, we can see there are two new items, which is unearned rental income RM400 and rental income RM800. For the fifth step, we need to recognize revenue. In statement profit or loss and other comprehensive income, new rental income is RM800 and will be under revenue. So this is the example. In other income, rental income RM1,200, we will minus RM400. So the new amount is RM800. Okay. And this is statement of financial position. Inside financial position, we will notice that unearned rental income will be in current liability in statement of financial position. It will become RM400. It will become current liability because we has received the payment, but we has not give the service yet to our customer. Okay, that is my part. Then my friend Tayalan will present to you question 2.
Okay, thank you, Moimin. So my part is a deferred expense, about deferred expense. So let's go to the question 2. So the first step, we are as same as question 1. We need to identify the contract first. So let's see. This is a trial balance for Perniagaan Chomel. So let's see the additional information. They stated that salary is 400 paid in advance. So that means that is already paid extra, but we haven't not consumed yet. Next slide. Okay, so first step is we need to do the journal, and then we need to first know which are the salary expense and which are goes to prepaid salaries. As Mohammed said before, prepaid sale is the expense that we paid for in advance. So right here, January to June, the salary expense will be 4,000, and the prepaid salaries which is they paid in advance we goes to 400 after the June. So for our accounting period we do until June only. So for the 30 June entry, for journal entry, so the prepaid salary we goes to debit side 400 and salary expense we goes to credit side. Next slide. Okay, next we're going to do the ledger, and then so right here salary expense, so the prepaid salary will be goes under the credit side of the salary expense ledger, and down there will be goes to profit or loss 4,000, and then later we goes the transaction will goes into statement of profit or loss and other comprehensive income. So other than that, prepaid salaries. So the prepaid salaries will goes under debit side, which is salary expense for 400, and down there will be balance bring down 400 for 1st July. Next slide. Okay, let's go to trial balance. So as an earlier account will be the salary expense, and the new account will be prepaid salaries. So the salary expense will be 4,000, and the prepaid salaries will goes to 400. Okay, so the prepaid salary will be asset and salary expense will be expense side. Later on I will explain more about it. Next slide. So for the statement of profit or loss and other comprehensive income, so the as I said before, salary expense will goes under expense in the statement of profit or loss and comprehensive income. So it will be 4,000 under expense as a salary expense. Next. And the last part is a statement of financial position, which is the prepaid salaries is under current asset. Because why it is current asset? It is because prepaid salaries is under 1 year's transaction, which doesn't go more than 1 year. So like that. So prepaid salary will be under asset 400. That's all for me.
Okay, for analysis question 1, we identify the first step, we identify the detail from additional information, which is a deferred revenue. Then we will make the adjustment entry. After that, we will transfer deferred revenue into the ledger. And after we finish the ledger process, we will post it into a new adjusted trial balance. And from the adjusted trial balance, we separate it to prepare in statement of profit or loss and other comprehensive income, and prepare prepare statement of financial position.
Okay, for the question 2, it is quite the same for the question 1 too. And first of all, we need to identify the details from the additional information, which is deferred expense. And second step is make the adjustment entries, which is goes to journal. And the third part is transfer the deferred expense into the ledger, so which is we convert the journal into the ledger. And next is post into it post it to adjusted trial balance. And the fourth is, and the before the last is prepare statement of profit or loss and other comprehensive income. And the last one is prepare statement of financial position.
As for the comparison of question 1 and question 2, we will we will compare it in four sections, which is identifying items, subtracting accounts, recognize revenue, and determine accounts. For question 1, the identifying item is by looking at the additional information, which is stating that the total rental income paid to the company is RM 400 that has not yet been completed. Then next we will separate the accounts into new account named unearned rental income, which will be classified under current liabilities. Next we will recognize the revenue by determining the revenue that is recognized in current financial year, which is RM 800. Next, we will determine accounts. Rental income, which is under other income, will be debited in the amount of 400, and unearned rental income under current liabilities will be credited amounting to RM 400. For question 2, we will identify the item by looking at the additional information given, which states that the salary amounting to RM 400 were paid in advance. Next, we will separate the accounts into newly created accounts named prepaid salary, which will be classified under current assets. Next is recognizing expenses by determine the expenses that will be recognized in the current financial year, which is RM400. Next, we will determine accounts prepaid salary, which is classified under current assets, will be debited in the amount of RM400, and the salary expenses, which is classified under the account expenses, will be on debit side, will be on the credit side, amounting to RM400. That's all from us regarding this topic of deferred revenue and deferred income, deferred revenue and deferred expenses. Thank you very much.